This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're going to talk about insurance policy warranties and why warranties are promises that must be kept by an insured. The term warranty is a word of great power. Generally, a warranty can be defined as, in insurance law, a statement or condition forming part of a contract whereby an insured agrees that certain acts have been or shall be done, and validity of contract depends upon exact fulfillment of the condition, regardless of whether the breach relates to or causes a loss sustained. A warranty in an insurance policy is a special kind of representation where the person seeking insurance promises that the statements of fact are absolutely true, that they know that the insurer is relying on the truthfulness of the statements, and that each statement, in fact, is material to the decision of the insurer to insure or not to insure. Warranty has also been described as, quote, the term warranty frequently has the connotation of an affirmation or a promise. However, functionally, the significance of a warranty in an insurance policy has been and continues to be that it establishes a condition precedent to an insurer's obligation to pay. When an application for insurance is attached to the policy and made a part of it, the statements of fact in the application are converted from mere representations to warranties. By accepting the policy with the application attached, the insured acknowledges that it has warranted to the insurer that each statement of fact in the application is absolutely true, and that the policy will be void if not true. An insurance company can extract from the insured a warranty of any factual matter it considers material, and may reasonably provide for voidance of the contract if such warranties prove false. To do so, however, it must be stated clearly and unambiguously on the face of the policy. The United Kingdom Insurance Act of 2015 abandoned the literal compliance rule so that rescission is no longer the automatic remedy for breach of warranty. Instead, a breach of warranty only suspends coverage until it is cured. In addition, an insured who breaches a warranty and fails to cure can recover if it shows that the non-compliance with the term could not have increased the risk of loss which actually occurred in the circumstances in which it occurred. Failure to comply with a warranty can convert a clearly covered and compensable claim into one that must be rejected. It is therefore imperative that the adjuster understand what a warranty is and how it affects the investigation and adjustment of a claim. And of course, the insured must understand what a warranty is and how it affects any potential claim. New York insurance law defines a warranty as, quote, any provision of an insurance contract which has the effect of requiring as a condition precedent of the taking effect of such a contract, or as a condition precedent of the insurer's liability thereunder, the existence of a fact which tends to diminish, or the non-existence of a fact which tends to increase the risk of occurrence of any loss, damage, or injury within the coverage of the contract, close quote. In a case called Certain Underwriters with Lloyd's versus Jimenez, a Florida Court of Appeals case from 2016, Lloyd's appealed a final judgment following a non-jury trial in which the trial court granted declaratory relief to Raul and Ada Jimenez, the appellee's homeowners, and determined that Lloyd's was not entitled to rescission of the property insurance policy issued to the homeowners. In 2007, Jimenez, on behalf of himself and his wife, Ada Jimenez, completed and executed an application for homeowners insurance policy on their home built in 1985 with assistance from their insurance agent, A&A Insurance Underwriters. A&A submitted the Jimenez's homeowners insurance application to a managing general agent at Lloyd's. During the application process, A&A asked whether Mr. Jimenez had a smoke, temperature, or burglar alarm, and if so, whether these alarms were monitored. Mr. Jimenez said he had a monitored central station alarm on the property. On the application form, Mr. Jimenez designated the central station monitor as a protection device that monitored for smoke, temperature, and burglary. After signing the application, Mr. Jimenez was given a copy and was given a chance to ask questions and make sure his answers were true and correct. The policy was given a discount because of the representation that the Jimenez's had a central station alarm monitoring for smoke, temperature, and burglary. The policy was renewed 3 times with the same representation and warranty about the alarm system. In 2009, there was a kitchen fire at the Jimenez's home. Delta Alarm System monitored and maintained the Jimenez's alarm system at trial. Jose Quintero, the corporate representative of Delta Alarm Systems, testified that the Jimenez's had a burglar alarm but not a central station monitored smoke or temperature alarm system. Lloyd's expert testified why the alarm warranty was material. New York law has long provided that the breach of an express warranty in a marine insurance policy, whether material to the risk or not, whether a loss happens through the breach or not, the insured forfeits his right under the policy. As New York Court of Appeals has explained, an express warranty in a marine insurance policy must be literally complied with, and the non-compliance forbids recovery regardless of whether the omission had a causal relationship to the loss. In my opinion, a warranty is an insurance policy is an important and enforceable promise made by the insured to the insurer as an inducement to issue the policy. A failure to fulfill the warranty voids the coverage. In marine insurance, a key warranty is a warranty of seaworthiness, while in land-based policies, the warranties only one sees are usually warranties of security like burglar or fire alarm, sprinkler systems, the need for a safe or a security guard, the kind of alarm system that the Jimenez's promised to provide, or even regular inventories or a very big safe. All are important to the risk and must be met and fulfilled by the insured for coverage to apply. This video was adapted from my blog, Zelma on Insurance, which is available free to anyone who clicks on the URL zelma.com/blog. If you found this blog informative, please tell your friends and colleagues about the blog so that they can subscribe. You can subscribe, they can subscribe, all free at the link in the blog. You can also subscribe to my videos on rumble.com or on youtube.com, and if you do, I'd appreciate it if you click on the like button on YouTube and the thumbs up button on Rumble. And if you're interested in further detail about insurance, insurance law, and insurance fraud, please consider subscribing to my Substack publication. Thank you for your attention.